Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. We're live. We're coming from the tail end of earnings season on a leap year day here.
G'day, mates.
G'day.
Yeah, it's 29th.
29th, yeah. We've got some good news to start off with. I'll chuck out a couple. I thought the first commercial moon mission was pretty cool. So Odysseus moon mission, first commercial lander to land on the moon, opening up the new age of space exploration, I feel like.
Didn't the Japanese do something recently?
Yeah, but Japan's a country, not a company.
Oh, sorry. Okay, you're right. That's a good point. Noted.
But yeah, so it's the first commercial one. It's the first commercial one, which I think is cool.
That is very cool. It didn't get much coverage, did it?
Not that much, really. It got coverage from like the few like pro-progress, whatever, techno-optimist sources, yeah. But not like a widespread thing. I mean, I guess it's like old news now. It's kind of like a Falcon 9 launch or something. Like no one cares anymore that, rockets can go up and land.
Not nearly as interesting as a drunken politician lying on the streets of Canberra, I guess. So. Relegated to the back pages of the newspaper.
Yeah, pretty much.
I got one as well. There's a study that came out basically showed that, one of the most effective ways of treating depression is actually dance. So I think that's good news because it's probably something that some people have intuited for a long time. But, dance is something that's like available for everyone for no cost. You don't need to go to a doctor for it. And at the same time, it's not going to have, withdrawal, or you're not going to create a dependency on it.
That's true. That's true, Claude. But I think my dancing should come with a health warning because it might be good for me, but it's probably not good for any observer.
Well, this is an interesting thing is that actually makes you think how much, for many people in the population, they probably feel like they can access SSRIs, which then take a month to have an effect, more easily than they can access a safe and comfortable place for them to dance. So I think, that probably gives us a hint as a society of how we could be a happier society, that, there needs to be outlets for people to do that. So anyway, you can find that. So if anyone's feeling down and wants to do something positive for themselves, I definitely think that the science shows that, go dance. Go dancing.
Dance like
Put
no
some
one is
music
watching.
videos on the TV.
Yeah, you can dance at home when no one's watching. Maybe that's the best way to do it. I definitely dance with my kids all the time. So
yeah,
there
you have it.
Yeah.
One thing I saw was the world's largest EV battery maker is going to cut costs in half by mid-2024. So that could change the economics, I suppose, on battery supply and cost.
Pretty cool.
Move in the right direction. I actually haven't dug into that beyond the headline, to be honest, but it did catch my eye. I wonder, is that a scale thing? Is it a lower input cost thing? I'm not too sure, but it's good. It's good news.
There's some in the US, right? There's, I think it's BYD are launching an $11,000 electric car, which is
wow.
a crazy price point for an electric car, which I think uses a slightly different battery formulation. I could be wrong. I know that BYD is experimenting with sodium-based, which we talked about on a pod a while ago. But yeah, it's a weird time in the US with EVs because isn't Tesla only expecting 11% growth or something? It's talking about an off-cycle year,
right.
But we're kind of going from this early adopter to the mainstream. And yeah, it's interesting. Chinese automakers are just cleaning up because they've just got such vast amounts of cars that are produced there. I guess they've got so much scale and probably some subsidies and whatever else. But yeah, it's an interesting one for the transition, right? Because you've at the same time got a lot of geopolitical tensions. Do people want to be dependent on China for something as important as transportation?
That's so interesting. Do you know what's exploded around my area? I don't know about yours or listeners, but e-bikes are I remember I had a go of yours a couple of years ago, Claude. It was such a
I love it.
It was great. It was so good, the assisted pedaling and everything. Anyway, and then it's just lately, it's just everywhere I go, I just see them everywhere.
It's the golden age of e-bikes, before there's a backlash, before there's too much backlash, and the motorists start trying to run you down again.
Yeah. They're virtually motorbikes in a way. There's a lot of speed you can get on those things, right?
It's just so delightful, because living in Bronte and then getting into whatever it was, Surrey Hills where we were, it's so hilly, and so it was either, my old way of doing it was to ride a normal bike to Bondi Junction and then catch a train, which is like a metal tube of infection. And so it was this is even before COVID, by the way, because I have, I have a problem fighting off diseases. So I got an e-bike and started riding through Centennial Park. Was it? Yeah. And it was so much nicer way to get to work.
Yeah.
I like them a lot better than the e-scooters. Those things feel like collarbone breaking machines to me.
They're a lot more stable.
I've got a friend who's French, and he said there's plenty of kids in France that are missing the front of their teeth because parents will use the e-scooter and put the kid in front of them, and like they go right into the handlebars. Like it's in the, it's one of those things that's like a known risk when you get on with your kid.
My kid was riding his proper bike, like his little bike, and he had a mad crash the other day, and he's now minus one front tooth.
Oof.
Yeah.
So
my mate worked in ER in New Zealand, and when all the e-scooters came out, and it was like majority of Friday night accidents with probably half
alcohol and e-scooters
e-scooters, and they'd just be like horrific, like bones out of arms.
Oh man,
yeah. No, I like the e-bike. So I saw a kid on an e-bike, and I'm I'm a grumpy old man about it. I'm like, you should still be pedaling, like at your age, like this 7-year-old.
Your joints don't
age comes for us all.
One other one that I thought was good news is Neuralink's implant can move computer mouse by thinking. And I guess I dug into a little bit more on Neuralink. I do think that they're doing some impressive stuff. They seem to have solved the brain scarring issue by shrinking the transistors, the connections, so that they're smaller than the gap between two neurons, apparently, which means that they don't scar. Yeah, it was from someone who's kind of some of the inside story of Musk and his actually impressive engineering or ability to corral other engineers to do impressive feats. It does sound like there's something a bit more there than I'd have been thinking about before. So
it's interesting.
Pretty cool. Let's get into some news. What's caught your eyes, Claude and others, over the last? Well, we just had inflation numbers come out as well, so I thought those were kind of positive for Australia. It seems like not as high in most areas, but there's some areas that are still really, really ripping. So a lot of services inflation's high. Insurance inflation is 16.3%, and a lot of other rents are still 7%. Quite a few services stuff is still pretty high. I don't know if you guys have any thoughts on that.
Insurers are trying to sort of compensate for losses in bond portfolios. I bet you that's got an angle. I'm shooting from the hip here. It just occurred to me while you were talking, but I think when it comes to inflation, my current thinking with it is, and I always think this is such navel gazing when it comes to inflation, because who really knows? But we had the double pronged sort of impact of a lot of sort of extra money sloshing around, and also supply chain issues, and it got up to 7% or so. But the supply chain issues were always going to resolve themselves. Like there's no cure for high prices, and that they were all always temporary kind of things, and we've seen things improve on the basis of that. But it's the what do they call it, the wage price spiral thing now, because services is different, right? Like when and what is the Australian economy? 70% services based. I think that part's going to prove to be a lot stickier, because even when you account, I know people like to say, well, over the last 12 months wage growth has actually been more than inflation. It's like, well, that is true, but over a cumulative 5-year period, most people are still well behind. And especially when you look at the distribution of where the wage growth has come from, a lot of people are really well behind and will demand and probably have a good case for pay rises, which, someone's higher wage is someone else's higher cost. And a higher cost is inflation.
If wages are ahead of inflation, that is inflationary.
I think there's going to be more wage inflation, but I think that there are some people that are massively overpaid, and hopefully for society, those people aren't going to be getting pay rises. But there are the people that are in sort of high skilled professions where there are shortages. I think at any given time, those kind of people are in a position to raise, get higher wages almost constantly. But except for those exceptions, I think there's a huge class of people who have been doing jobs like driving buses, teaching children, nursing, aged care. And those people need a massive raise. Anything that puts you on the front line of you're going to get COVID 3 times a year is going to have people dropping out, because older people who are 60 and might be on the edge of retirement, it makes no sense for them to try and brave 2 or 3 COVID infections a year, which could wipe years off their life, just to keep working for another year or two. If you're 60 or 62 and you actually can retire and you're teaching a kindergarten class, man, it makes sense to retire. That's the best thing.
I hear what you're saying totally, and I agree with you. It's like the way things are allocated aren't always fair, but at a deeper level, you could sort of argue it's going to be determined by the market. If you've got a skill set that can demand a much higher salary, you'll get it if you can, whether it's right or fair.
But that's what I'm saying is that's the market will push up the wages for like nurses and that kind of stuff. It has to.
That's why collective bargaining and unions are actually, I'm a big fan of that kind of stuff, because there's much, you kind of, that's where the power lies in those kinds of industries. You need to cooperate for it. But you make a totally valid point. But the point is that unions and employee representatives will now be able to, have been for a while now, be able to present a very reasonable case. Well, hey, we need a pay rise. We don't have enough people doing the jobs here. Everyone's cost of living has gone up, and so on and so forth. And it's just, I think I was just going to say the 2 to 3% range, I think is a long way off. It's a long way off, even though it may still continue to moderate for a bit.
The thing I like about unions is that they can get the actual pay rises that are needed. And that's really important. The thing that I think hampers a bit of society about unions sometimes is that in other industries where actually pay rises are not needed, the unions can still get a pay rise. So it's sometimes
there's always going to be a natural tension. It's a good thing. There's always going to be a natural tension.
I could not have a less of an affinity with like the union vibe kind of people that I meet sometimes in Canberra. But at the same time, I 100% think unions are a social good and want to live in a country that has strong unions. Like, absolutely.
Well, you do if you're a factory worker, I'll say that much.
They just hate me because I'm a capitalist anyway.
Yeah. Two things can be true. Two things can be true at the same time, is all I'll say.
Yeah, I think unions can't, like, if you look at the unions in like Scandinavia and stuff, it's all about how well they're run and whether they like become politicized or not, or just act for their members and stuff.
It's any institution. Yeah.
Cool. So I guess that any thoughts on inflation? I don't know.
I'll bring it back to
inflation beneficiaries.
I'll bring it back to the markets. I think the markets seem, at least to me, to be very much pricing in more a fall in interest rates.
Yeah.
And I think the decision makers are going to be in this really difficult position of, if inflation does prove to be sticky, yet we are sort of having anemic growth or even the potential for degrowth, for that horrible word, that I think there's a potential sort of stagflation kind of scenario there. And eventually, when push comes to shove, they will yield on interest rates before they yield on the fight for inflation. And I think the market sees that. And I think, I don't know. So I had a discussion the other day with like the Magnificent Seven, right? But you actually look at those stocks, they're on PEs of like between 25, and I think even Tesla's like 44. Now that's high, and I don't want to get into the debates of those particular companies, but WiseTech, Xero, Altium, like they're all Pro Medicus, they're all on PEs of more than 100, right? And it's not that they are all outstanding, best in breed companies. I love them all, but the valuations are really stretched. And I feel as though there needs to be some component of that, which is an interest rate oriented kind of calculus, because how else does it make sense?
Yeah, I mean, I guess it makes sense because everyone's expecting rates just to come back down, right?
Yeah.
And it's just if they don't. And I think that we tend to think in like extreme scenarios, but there can just be a scenario where it comes down a bit, but not that much, and rates come down a bit, but not that much. Like we tend to think of it so really binary. Everyone's like, oh, it'll go back to normal, so then rates go back to like 1% or something. But they could just stay, at 3% for like a long time. And that gets
this is normal. 1%'s not normal. Like, I think that's the other perturbation that's sort of out there. Like, no. Like, in fact, normal's higher than where we're at, I would say, over the longer term.
Yeah.
Okay. Well, here's a question that we can take, and then we can lead it into a little small cap stock discussion as well. What do you guys think, if it does have, a little bit higher than usual, as it used to be like 3.5% kind of inflation, it just sticks around there, bounce around there for a while. What are the implications for property prices in this? Because it was really interesting the other day, Matt, we were chatting with a friend, and he was saying that right now, say in Brisbane, and this has got me looking at one-bedroom apartments in Brisbane, basically the economics for building a one-bedroom apartment don't make sense anymore. But just because like the materials and the labor and everything, it's just not enough. But then at the same time, a rundown old Brisbane apartment's yielding easy 5% rental yield, right? Which is actually more
5%.
Yeah. So if you've got cash, like, this is why I'm thinking about it, because if you got cash, you could put it in a a 1-bedroom apartment in Brisbane. Hopefully it doesn't go underwater, but, and potentially get a better yield if it was just like a long-term kind of thing. So and also
You've
surely...
changed, man. You've changed. If you're getting excited by a 5% rental yield, who are you? Where's Claude?
What do you mean? Don't you remember in 2016, I bought a house like ages before you guys?
There was a non-financial component to that. Like that was a lifestyle sort of oriented decision. I'm not saying it, like, for some people great, but I'm a little surprised with you because you like your small caps, you like a bit of spice, you've had some pretty good long-term returns, and then you look over, you turn your head to the left and it's like, oh, there's a Brisbane 1-bedroom unit yielding 5%. I'm all in. Like, what?
Well, I feel like, if you spice that up with like 50% leverage and it's yielding 5%, it depends, I guess, what you can borrow at.
Okay.
But
I get you.
Yeah, no, you're right. And I probably should have just followed you into Bitcoin, mate. So, my bad on that one.
Not too late.
And anyway, I diverged. But yeah, the point is, if we do have this inflationary environment, is there something in that will finally pop the Australia property bubble? Or does, in fact, it just... in some ways make it persist because the construction costs and all that kind of thing go up?
I think persist. I don't think it pops it. I think it would pop it if it got really high and you had to really stomp with the interest rates. But I think that what you're talking about there, I don't see
exactly.
That
if it's got the risk to the pop was uncontrolled inflation, very high interest rate rise, people can't afford it, mass selling, right? That's the risk of the pop, in my view. And then slightly higher than normal inflation basically just will support it. So I'm not saying like apartments in Canberra are terrible. Like it's like a 3% yield, but in the right place, like I feel like there's property that's still okay.
That's gross yield too.
Yeah, exactly. No, the Canberra apartments are a disaster. They also have an additional tax for investors. Like,
dude, plenty of people in Sydney are looking at envy with yields in Canberra. I'll say that.
Oh man, Canberra's like harsh on investors. They actually really want they actually are a good model for what other places should do to make it more likely that everybody can afford an apartment, basically. But yeah, somehow they're still too expensive.
I agree with both of you. I don't think nothing pops this until there's some significant degree of forced selling. That's it. At the same time, I don't think the gains of the past you can extrapolate to the future, which is my concern with a lot of investors, is that's the base, that's the investment thesis. They extrapolate past capital gains and rationalize their decisions based on that. The government, this is too big to fail in every definition as the perfect use of that term in Australia. So I think even someone who is bearish on property, I'm acknowledging that everything will be thrown at this thing to prevent it from falling. And I think best case scenario for him here is, I think Alan Kohler made the point of just sideways growth for 20 years or something to sort of bring affordability back. That's probably the best case. But if there is ever, I think the key economic figure to watch would be unemployment. If that ever got high or wage, or just back to your point on inflation, if wage growth versus inflation, there was a real disconnect in those two, that's when you start getting forced selling, and that's when things get interesting. But it's the less likely scenario at this point.
Yeah, I think that's fair. I mean, New Zealand, you're seeing a big fall in some markets, but they also had a lot more supply because they kind of fixed some of their supply problems.
Who'd have thought that? More supply. Yeah. Oh, it's fascinating.
So bringing it back around to a small cap then, we had an article on A Rich Life written by Matt Brazier, who, long-term readers will know is an absolute cracker of a stock picker. And he, following up on one of his holdings, Mcgrath, the little real estate agent, I bet you love him, Andrew. And
quality, salt of the earth people. Quality, not just helping the community. Go on.
And it's it's a decent little thesis, in my view. Now, I'm not saying, this has been around for a while, by the way, and the stock has come up. This idea that there was an undervaluation of the rental rolls that was on their book. That is like the rental management firm where they're just clipping the ticket 8% of the rent or something. Ideally, quite a good business. And I guess this was trapped value.
That's Ferraris don't pay for themselves, Claude.
Yeah. This was trapped value for a little while. But actually what you've seen in the last results is they're selling these rental rolls now, which obviously is a bit of a one-off sugar hit, but it is a way to actually, get money out of them. And then the other thing they're doing is they are turning it more into a franchise organization. So an increasing percentage of the profits are coming from franchising. And the effect of this essentially is to minimize, I guess, or reduce the exposure of Mcgrath, the company, to the, I guess, property cycle and volumes and all that kind of stuff. in the up times, the franchisees will get some of that sweet, sweet profit or more of it. But in the downsides, like, it's the franchisee who gets into distress, and Mcgrath kind of can bump along. And that's really important when you have a company that's like, has basically, it was years ago, I remember writing an article about it, years ago, it was super overvalued when it floated. It was just like this whole thing. It's not that good a business. It came all the way down to 17 cents. And, I think, anyone can like just Google, but like maybe not the most stable management you've ever seen either. And so ultimately it's a bit of a turnaround play. But in the turnaround play, if you start attacking that downside, if you start attacking and reducing the thing that like what kills this kind of thing, that's actually where you can get upside in a turnaround play when something is sort of priced for being a real risk of dying kind of thing. So because of that, if you take out that downside, then it's quite possible for the market to start looking at it and saying, it's not that expensive, basically. Essentially, what your situation is, the net asset estimate in the company is like roughly the share price. So obviously it's a pretty simple kind of investing, but when you say, look, the downside of this is minimal, and by the way, this investing doesn't always work, so I'm not trying to say it's fail-safe, but one style is, look, the downside's super minimal in this if I'm willing to just sit in there. So if I hold it, I've got a potentially quite good upside, but my range of outcomes is almost certainly positive. And I feel like that's the kind of thesis for Mcgrath. And it's not like your long-term compounder, multi-year, multi-bagger, it's going to change your life kind of thing, but it could be an undervalued small cap. I don't own shares in it. And of course, this isn't advice, but that's sort of the idea. And that's I'm using it as an exemplar to illustrate, I guess, a type of investing thesis, which quite often can work. So yeah, that article of Matt's is on the website. But yeah, that's one little small cap that I wouldn't thought I would be talking positively about anytime soon. But yeah, it could actually be interesting.
Yeah, you make a good point. I mean, I've mentioned it too many times for it to be new, but the asymmetry angle of investing is basically my whole deal. Whatever way you want to play with it. I think that if you don't have a positive skew to the upside, you can't know the future. But if it's sort of like the dice need to be a bit loaded, right? Otherwise,
that's the idea.
Flip. So I love that. Well, this is the smallest point in the world, but I'll make it anyway. I did notice just while you're talking, looking through their slide deck, they're still opening offices. And my thought is, where in Australia can you walk down any sort of main street and not bump into 8 different real estate agents? Like, what suburbs are they opening new offices in?
I'm not in New South Wales.
Yeah, I mean, I guess there's one like next to Ayers Rock or something, or no, because like there's if there's like one
Boogaloo, thank you very much.
I can throw a rock right now and I'm going to hit the roof of a real estate agent. Like, it's just there everywhere.
What else? Anything else catching your eye in earnings season?
I thought I'd mention one that I quite like, which is Objective Corporation. Now, their results didn't shoot the lights out by any means, but at the same time, I think that now is an interesting time. So what they did is they changed their accounting treatment to start capitalizing about half of their R&D rather than all of it, which is what they used to do. Now, this makes a unsustainable and one-off and not real increase in their profit before tax. So you take the 50% gain in profit before tax and don't even think about it. But the point is, even if you back out for all of that stuff, which, by the way, they make it easy to do, and which they warned that they were going to have to do, and which they said that the auditors made them do. So there's no, I don't think it's cheap point scoring to have a crack at them for doing this change, which also just brings them in line with other similar software companies. But at the same time, the underlying growth was still there. So it was still kind of good. And at the same time, I just think now, yes, okay, on these results, and everyone's going to be like, oh yeah, but they changed the accounting, so it's not even special or whatever. But really, they're just putting it in line with others. Basic earnings per share of about 17 cents. Double that, you get 34 cents. At $13, divide it by 34 cents, and you get 38 as a PE ratio. And your guess is as good as mine what the underlying growth is. But they think that they can do 15% sort of ARR growth is kind of where their underlying growth target is. Now, they might come in a bit below that, but at the same time, I think we should see over the next few years EBIT margins creep up a little bit. Certainly, that's what they're aiming for. So that should bump your profit growth above 10%, call it somewhere between 10 and 20%. Well, you've got a stock, a software stock with, honest, competent management. I own shares in Objective Corp, have for a long time, bought some recently for the results. And yeah, ultimately, I just think that that's kind of ticks a lot of the boxes I looked for: honest, competent management, growing, sticky software. Yeah. And so this is, for me, like, ideally, it is one that I could just buy and hold for a long time. And also the other thing is you got to look at that market situation. Now, one consistent seller has been, I think his surname's Fisher, a former director. He's been around, Mr. Fisher, for a really long time. Marlane is his holding company. He's been selling way back since, the Objective share price was like 20 cents. So he's always basically, he started with a big chunk of the company and he's always been exiting. And yeah, he's still got a little while to go to exit. But I have no idea, I've not checked, but I wouldn't be surprised if the volume that came through, the unusual volume that came through just before earnings that pushed it down to $11, gut feel is that's most likely to be Marlane, because that's, the big holder that has historically been selling. Someone could check that if there's any brokers out there. If you can flick me a message and let me know what that sell-off was, that'd be great. But yeah, ultimately I could be wrong about that, but I just feel like that's kind of a setup I'm looking for. If so, some guy's been selling forever, it's probably not like that much of a insight that he continues to sell, and meanwhile it ticks some of those other heuristic boxes. So yeah, happy holder of that one of my larger holdings at this point. So and hopeful that it is a long-term compounder, basically.
Well, it is. I mean, up to
that's
this
what it's
point,
been so far. Yeah.
The point I want to make with Objective Course, when you're in small caps, it's easy to sort of gravitate into companies that are a much earlier stage in terms of pivoting to a profitable, viable, cash flow positive situation. But with Objective Corp, it's one of those stocks that you could go back 10 years and it was profitable, was paying a dividend, had a huge inside ownership. But all the things, a good thrust of the buy case that you would make now, I think was largely true back then. So it wasn't as though it was, this will be a great, and it has been a great investment over the last 10 years, but because I think they will transition to profitability and they will scale well and they will do all of this. They were kind of, this was one of those ones that was hiding in plain sight, in the fact that it was just like, well, we're doing it. Like, what are you not entertained? What else do you want us to do? Obviously there's a degree of magnitude and how much that growth continues in the rest of it, but it is a very different proposition to a lot of small caps where we might sort of be looking and waiting for that inflection point of profitability. It's like, no, it's blown well past it. This was a much lower risk reward proposition than others, equivalent, similar ones in that space at the time.
What do you think of the growth, Claude? So they're saying basically that it's going to return. What's the kind of, what are the suppressing points?
As a proxy for underlying growth, I used their target of 15% ARR growth, and then kind of, I would make in my head an adjustment down for the fact that, for example, in this half, ARR growth was only 10%, not 15%, ergo below their target. And then I would make an adjustment a little bit back up, in the sense that I think that there is some operating leverage coming through in the business. And so that's not on R&D. That continues to go up as a but sort of stable percentage of revenue, but there's still a bit of operating leverage over the other costs, I think. So then I would, bump the growth rate up a little bit from there. That could be too bullish, of course, and that's one of the areas where the thesis could fail.
Yeah, I think for me it'll just come down to growth from here, right? So if the statutory revenue growth was 5%, whatever, if that was more the growth rate, then it's probably pretty expensive. It's more like, I guess it'd be like price is the most premium end, or the top end of what you'd pay for something that's growing at that rate. Like, there are companies that grow at that rate and are high quality. But then if it's growing 15%, I guess it's quite cheap. So that's probably it all comes down to that growth rate over the next 5-10 years.
Yeah.
Probably, right?
So they've just completed a transition away from license fee style stuff, which is now finished. So statutory revenue really should go up more than 5% from here. If it doesn't, then I'll be slightly concerned. Yeah. But, that more of their revenue has gone recurring, and as that sort of project and license revenue falls off, then you've seen that slowing, but that should be done now. So that's an absolutely fair point.
They've done really well. And I was discussing the other day how hard it is selling to government clients, and how some companies manage to do it. And I guess they've gotten to a stage where they're well known enough within government to become like the incumbent.
Such a key point.
A couple of years ago, I actually asked a question, which was a bit of a tough one, and the CEO said as much, but the question was something along the lines of, if you're losing them, how does it happen when you lose a contract, when you're tendering something and you don't win or whatever? And he basically, I can't remember the exact thing, I think it's in one of my old articles, but essentially he was saying, well, if they've lost the contract, then that means they've failed to like be in there way before the contract even went to tender. Like the idea is they're supposed to be engaging with the person who's going to put out the tender to the contract before the tender's even out there. Like that's where I guess you need to be in on the process. Like you're talking with them before the tender goes out, and you're just getting, basically making sure you're completely ready for it and that kind of thing. I'm not exactly sure how it works, but it's like the constant engagement and having an idea of where the puck is going, I guess, sounds like, you know, where it is. It's not a matter of just you like, oh, a new tender's out, now I'm going to start thinking about it today. I think that's kind of where, and I have no idea how they do that, by the way, and I'm totally paraphrasing.
That was objective you're talking about?
Yeah, that was kind of my understanding of it. It was like, I guess in a very, this is not what he said at all, but the way I took the answer was like, well, you got to shift your focus even far forward before the tender kind of even went out, or he didn't say those words, but that's how I understood it. And that's like really interesting, kind of, it shows just how difficult it can be, like how long the sales process is in these industries. And I think that's a real disadvantage. You know, that's why a company like Pro Medicus is basically in a way better position than Objective, because even though it does still have very long sales cycles itself, for smaller stuff, it can still move way quicker. Whereas I think it's probably super long for Objective, even when it's just a local council they're selling to.
Yeah, I think that technology one are basically the same approach. They just know about they're chatting to these government agents so far ahead. And then by the time the tender comes, they've probably designed it thinking of like technology one or Objective potentially, right? Like if you do enough of the groundwork. And so then if you're another company going for the tender, you're kind of like the patsy. Basically, right? You're going for something they've already really kind of made a lot of their choice. They still do the tender. I'm not saying it's completely biased, but they've got something in mind and they've tailored it.
I live in Canberra. I see it all the time. Like half the job ads you see, like are job ads that they just have to put out, and like within the department, they already know exactly. Exactly. Or worse, there are two people within the department frantically playing politics against each other to see which one of them are going to get it, and miss the third candidate that got no chance.
Yeah, it's just like it's like getting a job, right? Getting a job, the best way is to have like the friend recommend and they want you, and then they put it up on Seek as well. But if you're just going on Seek rather than through that warm referral, you've probably got a much worse chance.
It reminds me of the nobody got fired for buying IBM line. Like,
well, that's the thing.
When you look at it in the government context, it's not to be disparaging in any way, but look, I'm in a comfy position here. I just want to make a safe bet, right? And there's nothing safer than like when umpteen other departments and agencies you all sort of speak to regularly have all used it and recommended it. It's such an easy sort of decision. So it's a great competitive edge once entrenched.
100%.
Shall we move on then? What stock do you guys want to discuss next?
Gosh, I'm not a...
Well, let's do JB Hi-Fi, shall we?
Yeah, tell us about JB.
Yeah, all right. So JB Hi-Fi, yet another one of the retailers sort of on the rebound. I think, you know, that has been a real feature of these results. We've got JB up, we've got Lovisa up. There's more besides that, but they're two leaders that I guess we follow because they do such a good job. Nick Scarley was up as well, which is considered another leader sort of in retail, one of the better operators. And yeah, so I guess the takeaway for me is, I think when we came on the show a couple of weeks ago, we were talking about some of the early retail results, and I was saying, oh, you know, one swallow does not make a summer, etc. And I guess like the point that I was thinking of touching on now is that now that we have had a bunch more retailers come out, including, you know, the names I dropped there before, think that I guess, you know, the retail comeback is on, and perhaps that tells us an indication that we're not in any particular danger of having too much of a slump in the near term. I don't know if you guys agree with that. What do you think, Andrew?
I mean, you always see what you want to see, and I think any listener would know recently is that there's been dark clouds in my thinking, and that's a dangerous place to be because it usually doesn't pay to be pessimistic. But I mean, I think everything was down at JB, right? Like it wasn't a great half. It was just that it was priced for even a worse scenario. And I think what enthused the market was this idea that we've sort of seen like-for-like sales growth of 1.7% in January, which is encouraging, right? Like things aren't getting worse. That's really nice to see. Yeah. The trouble you have with when you've got very big retailers operating on retail kind of margins and that, it's like sales growth of 1% 1.7% is definitely going in the right direction.
Yeah, I should clarify what I said. It's not that retailers are smashing it. It's just that they're doing better than what the fear was previously, right? Like, there's a lot of these retailers were priced for like, oh, it's going to go down hard, guys. And to be fair, it hasn't been the strongest numbers.
Yeah,
but
nonetheless,
that was better than expectations.
It's an excellent point you made, and we said it at the time. I think that there's two tricky parts to that. Is obviously sort of you don't want to be too early on that because things can always get bad. But one of the things I struggle with is that where I do this all the time in both directions, where a growth thesis becomes a value thesis, and then a value thesis becomes a growth thesis. So I buy JB Hi-Fi because the multiple's just silly, and it's on probably trough multiples, and the things aren't great, but they're not as bad as the market thinks, and it's undervalued, so I'm going to buy it. But that's all good and well. But if that's your thesis, once it's corrected and shares have like done really well, I would say you either need to reformulate the thesis at this point, go, actually, no, still the market underbakes the strength of the consumer, or you close out your position. Again, that's not my style. I'm not someone who's going to trade that, but I think you just need to be honest with yourself. Is if that was the reason I bought it and that is now played out, unless I've got a way to sort of
I'm definitely not chasing this one.
Yeah, I mean, I'm not saying people shouldn't, by the way, either. I'm just saying if that was your starting point, then now is
a good example of what you're talking about is like beacon lighting, right? So there's only a handful of retailers we cover at A Rich Life, and Raymond does most of that. But that's like another one that, you know, it's come up massively. Its sales were down. I mean, its profit was down 15% and sales were flat.
Yeah.
And yet there we have it with the share price, you know, the share price like having good momentum and going up and up and up. And anyone who bought it 6 months ago is laughing. I mean, that was the trade. I think it's fair to say I certainly didn't get in on it at all. And maybe it has more juice to it. But, you know, with the retail sales, like with some of these individual better companies, we're seeing not as bad as expected kind of results.
Yeah. You got to take the wins, right? Like it really could have been a lot worse. So it's encouraging.
I guess the surprising thing is just the all-time high for the share price at the same time, right? So it's down results and all-time high. So, but yeah, I mean, not necessarily unjustified. Again, like it had been treading water for quite a while, and I think probably it's more like this perception that it can shrug off anything.
This is JB that you're talking about, just JB, for anyone who got confused there.
It's probably just a sense that they can navigate anything. It's probably what I imagine is, you know, driving that change of the kind of mental model people apply to put it on all-time high versus where it was, you know, 18 months ago.
Yep.
Yeah, it's like you would have thought it's such a competitive category, but like there they are. Like, yeah, I reckon you're right. It's just like, you know, it starts being people like, oh, this is a quality retailer, and up it goes. But I think it's kind of correct anyway.
Consistently above 30% return on equity, right? Like a staircase like earnings growth. It is an absolutely phenomenal retailer.
Yeah, the problem with retailers, like, it's not even a problem, but I just think retailers, you need and this is what I struggle if I'm going to be like writing about them and stuff like that. What I really want is find things that you can just back for like 10 years and never get out. But I think with retailers, probably at least the temptation for me is to try and trade it more. Like, there's a cycle, blah, blah, blah. But then at the same time, there are these quality retailers that just do keep on going, and they're the ones I guess you really want to own.
I think I mentioned it on the pod before, and this is going back many years, but I was always against JB in the sense that whenever I went in there a lot, and it was always crowded, and somehow I missed that signal. But what did catch my eye?
CDs? Where are the CDs?
Was there CDs and DVDs everywhere? It was like, how are you selling this kind of stuff? And I think with what it is that the consumer demand for technology, you know, be that phones, tablets, computers, TVs, that it is such like of the discretionary spend, like right up the top as a high priority. It is a lot of us very highly value our technology, and they've just done it so well with the in-store experience and the cost per square meter and all the inventory, like everything top to bottom. They have just done it so incredibly well and managed to evolve to that changing consumer demand, because guess what? New tech gadgets come out all the time. They're selling drones and stuff there now. I completely miss that. And that's... That for those that did see it, congratulations.
Yeah, and it's trust, right? The whole model is you don't understand technology. This mid-20s person does. They'll talk to you and tell you what laptop you should buy for your kids or whatever. Like that's if you look at the conversations that are happening, that's like 90% of the conversations.
Have you ever had a bad customer experience in JB? Like I never have. They've always been excellent.
Yeah, they're pretty tight. It's definitely like that would be kind of dividend stock that I'd consider. Anyway, moving on. So we had a suggestion from a listener, Oz Richard, on Twitter, and he suggested we take a look at Close the Loop Group, which is essentially a a company that's in the recycling industry, in particular, I think electronics are their main game. Have you guys had a look at this at all? And any high level thoughts before I delve into some of the specifics?
I looked at it at IPO and it did really well after that, and I didn't buy it. So it was like one of the better performing, particularly of that period that it came on. I didn't really like, when I look at the economics of what they do, it's a very tight margin game, a very low margin game, and just kind of recycling generally it's not a great industry, I guess. I didn't really like the industry fact dynamics of it. It's kind of like how marginal a lot of recycling is. I think you can get it when there's some government kind of incentives or structures that force it to happen. But a lot of recycling is super marginal. Like, it's often cheaper to bury bottles than to recycle them. And just the idea that you're getting a waste product and making money off it sounds really good until you think of how hard it is to do all the work and it's more like manufacturing or something, like a low margin manufacturing. But they actually did reasonably well out of the gate. I think they've come back off a bit more recently. They seem to be back trading where they were. So yeah, that was my kind of high level look at Close the Loop when it IPO'd.
Matt, if you know what was sort of the growth drivers? I assume it's like acquisitions and expansion. Is it?
Yeah,
that
they have been acquiring stuff.
Yeah, because organic growth is hard in that space too. I mean, I'm not overly familiar with the industry, but I imagine like if you're listing and you're looking for cheaper capital, it's a.
So the most recent result included the full impact of 3 acquisitions that they'd made, and their revenues, I guess, tracking ahead of guidance, I think is the point that they're trying to make. They had 106 million. 0.2. They've upgraded the full year FY 2024 guidance from 44 million to 46 million. Now, that's the first thing I worry about, because I'm like, I don't think EBITDA is actually relevant for this kind of extremely capital intensive business. They're physically moving stuff around and having some, specific processes. So obviously they do have very, very real depreciation, etc. So I don't think EBITDA, other than maybe that's what the bank cares about, because they just want to know if you can pay the interest on the loan. But I don't, as investors, wouldn't really use that as a valuation tool. I think where I come back with this is, and the reason that I guess I'd avoided it, is I've got no problem with this kind of business. It's just the kind of business I'd buy on a dividend yield. We've just talked about JB Hi-Fi. That's not exactly like the sexiest growth business either. That's also got slim margins. And they really showing how you can have a slim margin kind of business that can be good. But that's a dividend yield company. You're getting, if you buy the shares in that, your trailing dividend yield anyway is a little bit more after franking credits than what you'd get in the bank. So I think that's the kind of thing you want to be compared. Like, that's to me the obvious thing with something like Close the Loop is like, yeah, this totally sounds like something I'd invest in, but what's the divvy yield? And they're not there yet. So profit up, good to see. I would look at profit. That was profit up, was about 5 million. So if you just doubled that and run rated it, that'd be 10 million. Market cap 180 million, I think it is. So maybe 18 times on it. This is very back of the napkin stuff. But yeah, so it doesn't scream like obvious buy to me, but at the same time, is if this business started paying a dividend, so proving, because the dividend's the ultimate proof in the pudding, as long as they're not also like, you can, sometimes companies unwisely pay a dividend when they can't really afford to, but assuming it was a dividend they could afford, and assuming I was then getting a decent yield on that, I'd consider it pretty good. And maybe that's on the horizon, because if you look at the cash flow from this half, they did generate free cash flow in this half. So that's interesting. Let's see if they can get it for the full year. I would like this to be an attractive option, because it'd be kind of feel good if I was like making money out of recycling. And I think if it ever gets to that point, then there'll probably be quite a few people that think like me, and it might get a bit of a premium for it.
Yeah.
But yeah, in the meantime, I need to see that dividend.
Yeah, I can see that as being a potential driver. I'm sure that's what the bull case, a component of it at least, is this ESG drive. I mean, they make mention of the HP circular economy emphasis program that they've got, and the emphasis they put on that kind of stuff. And whatever you think of that kind of stuff, if enough big companies and they get enough contracts sort of going in that direction and virtue signaling with all of that kind of stuff, it could be a bit of a tailwind. So, I wouldn't rule it out, but yeah, as a newly listed company, I'd also want a little bit more water under the bridge, maybe just to sort of see that things are going in the right direction.
Yeah, I think it can get scale benefits if you get really big. It's like, it's more like, I think of it like a packaging business or something like that, It doesn't seem like a great business, but it can become quite attractive, as Claude says. It's like you can earn above your cost of capital on potentially like ending up being large slums of capital. It's not going to be like a huge grower, huge return, but yeah, I think it can work.
Particularly if it's hard for competitors to sort of set up and build that scale.
Yeah, because it's that collection network is where because
yeah.
a lot of the cost is collection, right? And the relationships to have it and the scale.
Yeah.
Like, you get big enough so that HP wants to work with you because you've got the scale to work with them, kind of thing. Or for all these guys.
Exactly. Like just a growing distribution network that's a little bit bigger, it can be a sustainable competitive advantage. It's not a deep and wide moat. You could think of it as a shallow, a shallow moat, but it's still there. And maybe you could think of it as even a shallow that wide moat. Some company that's very big could easily walk through it, no worries. But smaller companies are going to have a trouble. Like it's very hard if you're starting up from zero to just replicate a distribution network. If you're already a big company that has warehouses and maybe some other adjacent distribution network, then you probably can encroach on that space pretty easily.
Yeah, that's good framing.
I wonder if just general commodity costs could be a factor there as well when the cost the amount that they can recycle and produce material for relative to the cost of mining it fresh. It
does make a big difference. Yeah. So that's where stuff like, I just remember a few years ago digging into glass bottles and how they at a certain point started just being buried. They weren't processing them anymore because virgin glass became so cheap at that time.
Yep.
So that can be an effect. It depends on how they've structured the contracts, whether they're paid a margin or like a fixed cost, blah, blah, blah. But I think that's legitimately something to consider. And as I guess a side note, like some of those things can pay off over the long run, like kind of all the rare earths. I don't know if you track that. Like there's a lot of rare earths where people had just buried them when they pulled them out of the mine for years. And now they're actually valuable. So stuff like that it's not crazy and stupid necessarily to bury them. I guess that's what I'm saying. If it becomes valuable in future. Cool. All right. I think that was all that we had to chat through. Do we have what do you want to do, Claude? Do you want to do some gratitude?
Yeah. Absolutely. All right, Andrew, I hope you prepared for this, but I'll go first.
I hadn't until you just said it. I'm trying to think of something different.
You got a minute to think. I'll string
something
it out
different
for you,
from Bitcoin.
Can't be Bitcoin every time, mate.
All-time highs. Woo!
Well,
shout out.
I'm going to say 4 things today. First of all, my new focus for this year, since I haven't been having that much fun, is being healthy, hanging out more with friends, and seeing live music. So that's outdoors live music, by the way. But that's 3 things I'm thankful for. Had a bit of that lately, so feeling more positive as a result of that. So thank you. And also, the other thing that I have to chuck in, and I can't believe it's taken me this long, is trees. I love trees. Sometimes I actually hug them. Like there was a beautiful tree with a big low bough. It was just the perfect hugging height. Give it a good hug the other night in the Botanic Gardens. Yeah, that's great. I love trees. So that's my ones for today.
Very good. What do you got, Andrew?
Oh, gosh, I was hoping you'd go. It always comes back to me. I rail at the little things, but the big things I'm very grateful for, like the health and family, that kind of stuff. I'm very fortunate.
Well, you've never said that before on this pod, so we'll take it.
Mate, we feel like you're making progress from this therapy, mate. Well done. Well done. Good on you. That's a step forward. Good on you, mate.
Yeah. No, I'd say I'm grateful for catching up with Claude the other day. We caught up in person, went to a concert. It was very good. So the ability to do that, catching up with friends. I think everyone, when you get into like kids' life, you go into your own little family unit a bit. So you do. To get out.
Superstar DJs, here we go.
All right, should we close it there? If anyone has any questions, hit us on Twitter @BabyGiantsPod. Until next time, thanks very much for listening.
Bye everybody.